Okay, let me just here. Hi, Jack. So thank you for being on the show.
Well, thank you for inviting me.
First question, could you give us an overview of your journey as an investor? What did you do before, and what were the main steps, and where are you at now?
Sure. Yeah. So as you know, today I syndicate mobile home parks, and we manage a fund that owns a portfolio of parks. But the journey to get to where I am today started about a little over 20 years ago. So I was in the military, and I started listening to, back then you used to buy these cassette tape courses, the late night TV, Carlton Sheets cassette tapes and that kind of thing. So I got addicted to that. I knew I was a real estate guy. I started out buying land and building spec homes in the general contracting space. And then I started building a portfolio of single family homes with a friend of mine. And that grew into something that we didn't expect it would grow into. He got so good at finding deals that we couldn't fix them up quick enough and rent them out. So we ended up being a wholesaler. Turns out we were one of the larger wholesalers in the Phoenix metro area. And that's over the course of about 10 years, we bought and sold about 2,000 single family homes. So then about 2012, I got a little bit bored of the single family thing, and I started buying apartments. We did, anywhere from, we started out with little ones, and then that grew into, 100, 150 unit apartment buildings. We did that for a period of time, and then I accidentally tripped over a mobile home park, and I fell in love. It's one of those kind of weird afflictions, it's everything that you've heard about mobile home parks turns out to be true, and I had to do it. So I sold out of my interest in that company, and then I started a new one with a asset manager friend of mine. And today we buy mobile home parks that are underperforming in some way, and we turn those around, and we own them inside of a fund with quite a few private investors who ride that train with us.
Thank you. You said it happened accidentally. How did you bump into mobile home parks?
Well, I think it was supposed to happen.
Okay.
But I was buying an apartment building, and I had it in contract, and it was vacant. So the city, because it had been vacant for more than 6 months and 1 day, that they required that we bring the property up to current zoning standards. And the piece that was missing was it didn't have enough land for parking. So right next door, there was this small mobile home park. So I bought it. Now I had enough land. Long story short, I never ended up doing the apartment project because the numbers didn't make sense. And now I owned a mobile home park. So since I owned it, and it was a little one, but since I owned it, I thought, well, let's discover if everything that they say about mobile home parks is true. And it turned out it was. So best cash flowing asset I ever owned. Probably the easiest asset to own once you get through the hard work of turning it around. And yeah, it was a great asset. We owned that thing for probably only 3 years, but it was the easiest asset to own, and it delivered the most cash flow. So I kind of got a taste of it. We went forward and bought a whole bunch more smaller parks. I wanted to just do that. And then the current business partner and I decided that we wanted to go different directions. So we sold all the smaller parks and started a new company. That's all we do now is mobile home and RV parks.
So you've moved from small parks. What's the minimum size now to be considered?
Well, the interesting thing about parks is that depending on what your intention is, the way that we look at parks is building a portfolio requires really good on-site staff. So particularly if you have parks in many different markets, you can't be at every park at one time. So you have to have really good quality on-site staff. And the cost of good quality on-site staff on a smaller park just doesn't make sense. So you have to have enough spaces so that you can spread that cost, and then there's still plenty of cash flow. So we've discovered that about 50 pads is where I mean, you could do, I think that it starts to work at about 40 pads, but we really like to have at least 50 pads.
Thank you. So you talk about the turnaround process. Can you tell us more about that?
Mobile home parks, when you buy them, what we look for is we're looking for underperformance in 3 areas. One is the expenses are way higher than they should be. The other end of that spectrum is that the income is a lot lower than it should be. And then in the middle there is some kind of physical neglect or repairs or capital improvements that are obviously not been done. So typically if you look at a park, there's a reason why it's underperforming. They've neglected it so that the condition of the park is not one that would allow you to raise the rents in the first place. So you have to go invest a bunch of capital improvement dollars in there, to get it to a spot where you could raise the rent or it becomes attractive, particularly if you have vacant spaces or vacant homes that need to be sold. I mean, who's going to come buy a home for you on a promise that you're going to fix up the park? That's just a difficult thing to sell, right? So go in there and make the park amazing, and it's easier to sell those homes and fill up spaces and raise the rent and all those kind of things. So usually it's a combination of 2 or 3. Sometimes a park will have all 3 of those things. But we've acquired parks where if you drove by, you would never guess that it's underperforming because the park looks nice, but the expenses are way higher than they should be, and maybe they haven't raised the rent in 10 years, right? So there's you can't always see it by driving by the park, but typically it comes in all 3 of those phases. So when we acquire a park, the first thing that we do is fix the expense issues. So we've seen, I mean, we bought parks where the expenses were as high as 65%, which is dramatically higher than it should be. So the fastest way that you can influence cash flow at a property is to reduce the expenses. Second thing that we'll do is we'll try to gain income in an area where there's no current income. So let's say that there's a handful of park-owned homes that they're vacant and they're not earning any income. So initially, we would look at those homes and say, which ones can we rent out the fastest? So if some of them if they're all in terrible condition, then you wouldn't use that strategy. But let's say that you got 10 vacant park-owned homes, 4 of them just need some minor repairs and you could rent them out. We would do that right away to bump the cash flow and make sure that we can influence cash flow right away. Then you would start to go through complete renovations on the other 6 until you get them all sold. And then you go back to those 4 that you rented out and you'd fix those up and sell those off too. So when we're done with a park, we want to have all of the homes owned by the tenants so that we don't do any of the maintenance there. They're just paying lot rent. It's very stable. So, every park shows up. They're like parks. I joke around that parks are like children. So they're all different. You can't put the same set of parenting skill set on every child and expect the same result, right? So parks tend to be that way too. Sometimes they need more operational upgrades. Sometimes they need more physical upgrades. Sometimes there's a complete marketing upgrade that's needed. If you buy a park that has a terrible online ratings and anybody who's going to go buy a home is going to go Google it and see, okay, what's the deal with this park? Sometimes you need to completely rebrand the park. That means renaming the park. You go in there and completely renovate the physical characteristics of the park and make sure that the park's beautiful. Landscaping, pavement, clubhouse, office, laundry, all the facilities, all the amenities, you upgrade all those. And then as soon as a new tenant comes in and sees a new sign, a new name, like, okay, something's different here. It's obvious that there's a new owner, right? So it takes a little bit of time. Usually there's about a 6-month, when you start to turn a park around, it takes about 6 months to get a little traction there. But once you get it going in the right direction, we've literally bought a park in a town in Arizona of about 50,000 people. And I think it probably had the worst name or one of the worst names, from a rating perspective in the town. And inside of 6 to 9 months, it was one of the better ratings in town. So today it's the top park in the whole city. So it doesn't take much if you focus on that, but there's cases where you'll have to change the name and change the entire image of the park.
Is it complicated with Google to change that?
Not if you got a great marketing staff.
Oh, okay.
So I'm sure it's complicated, but not for them. That's what they do all the time. So we have a marketing staff that we work with that do all of our websites, all of our branding, all of our park rebranding, all that kind of stuff. But while we're in escrow, we typically know this is a park that we're going to change the name on. So we'll buy it with that thought process. Even the name of the LLC that we buy the park in will be the new name. So yeah.
Okay, you use a new LLC for each park?
Yeah, so there's a couple reasons why you do that. So if you're going to build a portfolio of parks, you want each one of your parks to have its own or be owned by its own LLC. So from an insurance perspective, that makes a lot of sense. From a exposure to potential risk, that makes a lot of sense. So you wouldn't want to have somebody trip and fall at one park and be able to have your exposure be all of your assets, right? So from an asset protection perspective, it makes sense. And then also it's smart from a bookkeeping perspective. So all of your books, all of your banking, like every park has its own bank account. All of your bookkeeping is specific to that park. All of your bills are paid out of the same bank account. It really helps you be accurate with your P&Ls and your taxes, and particularly if you're syndicating those parks and you're paying distributions to and profits to investors, you want to keep all those separate. Certainly makes it simple when it comes time to sell a park, when everything that's ever transpired inside of that entity is only attached to that entity.
Back to the turnaround, how do you reduce the expenses? What are the main strategies you use there?
There's probably a dozen places where we see expenses be high. So the first one, and there's every park will be different. We bought one park where it took 2 people to run the park, but when we bought it, they had 7 people on their staff. So their labor was more than twice as much as it should have been. And that was a case where the out-of-state owner, basically gave an open checkbook to the manager. His manager ended up hiring all of his family for everything that he didn't want to do. So instead of me doing the landscaping or the weed control, I'll hire my brother-in-law to do the weed control. Instead of me, doing the regular cleaning of the pool and the clubhouse and the facilities, I'm just going to hire my sister-in-law to do that stuff. So their labor costs were really, really high. But typically we'll find that there's ways to get the same exact benefit or value that you're getting in a park by just shopping it in an intelligent manner. So for example, garbage. So you buy a park that has 3 dumpsters. Maybe it only needs 2. Maybe the cost of 3 dumpsters being dumped twice a week would be significantly reduced if you had 2 dumpsters dumped 3 times a week. Like you just play around with those. You shop, different trash companies. Part of this comes from experience. You get to know, how much trash is going to be created per space. So that, part of that is experience, but you'll see that in the trash spot. You'll see that in some of our parks will provide Wi-Fi or internet, so particularly like RV parks, but you can shop those kind of things and reduce the expenses there. Insurance for a park. Most of the time, these parks, particularly if they're owned by a mom and pop, their brother-in-law is an insurance agent and they just get their insurance through them. So for example, if your brother-in-law worked for State Farm's probably not underwriting that insurance policy. They're probably going to one of the larger insurance companies that does park insurance. So they're just marking it up, right? So if you shop insurance and you go straight to companies, and there's a half a dozen of them that just focus on mobile home park insurance, you'll cut your insurance expenses by 40%. So there, all the utility line items there, any contract services or vendor services, any, even taxes. Like if you're intelligent about it, you can get your taxes reduced. So there's cases where it makes sense to approach that, and there's cases where it doesn't make sense to do that. And then landscaping. I mean, some of the things that really cost a lot of money are going to be like, let's say you have a water bill because your grass is getting watered 4 times a day, right? Well, if you change the timers on the times of day that it gets watered, and maybe it just gets watered first thing in the morning and in the middle of the night, for example, you use way less water. Your grass still grows like it's supposed to, but you cut your water bill. Or let's say half your sprinkler heads are broken, which we've seen that, right? So they're not even, half the water is not even getting on the grass. It's all splotchy because their sprinkler system doesn't even work. And then you can take that one step further, particularly here in Arizona. You say, well, why are we watering grass in the first place? Unless it's a resort kind of a place, let's tear this grass out and let's put in rocks and xeriscape landscaping that requires very little water at all, right? So you have a capital expense that's a one-time expense, but you might take a significant item out of your expense column, in the cost of running water and maintaining a sprinkler system. So you kind of look at every single expense that happens at your park and say, is this something that we can improve on through a change in the way our park behaves, or a different vendor or a different contractor or a different service provider?
Thank you. So in terms of property management, how do you go about doing that? Do you have a person you like? So you like to have parks of at least 40, 50 pads. What type of property management do you set in place? Do you have one tenant the tenant who takes the best care of their home is going to become the tenant in charge, or how do you go about that?
There's really 3 ways to approach that. So the common way that you'll see out-of-state owners do it is either through a third-party property management company. So a third-party property management company is going to come in there and they're going to hire and fire your staff. They're going to choose your vendors and contractors and service providers, and they're going to pay all your bills. They'll collect the rent, and then they'll send you statements every month. They'll do your bookkeeping and they'll send you statements. They'll deposit your rent collections in the bank, and that's pretty much all they're going to do. So you're not really going to get the problem with a third-party property management company is they don't have the same vested interest in the success of the park that you do. They're checking boxes, they're doing their jobs, and they're fulfilling the terms of their management agreement, and they have 30 or 40 other parks that they manage. So they can only really allocate 1 day a month to your park. That's it. Like, they just don't have enough time, right? There's not a lot of money being made managing mobile home parks unless they're really large mobile home parks, particularly in a major MSA, right? So if you have parks all over the place and you're asking a third-party management company to do that, probably not going to be able to move the needle much through their services. So typically, especially if you're buying value-add parks, you're going to need to do the management yourself. So when I say that, you become the third-party property manager. So you're making all the decisions with respect to whether or not we're going to raise rent, which homes are we going to fix up, and which ones are we going to rent, like all these decisions. When are we going to fill spaces? How much money are we going to allocate to which capital improvement projects? When are we going to do those? All of those kind of asset management strategic questions, along with how are we going to collect the rent? What kind of software are we going to use in our office? What kind of file storage are we going to use? Like all those things with respect to management. How are we going to handle maintenance? Are we going to do it all through contractors and off-site vendors? Or are we going to do it through hiring a maintenance person? So there's 2 ways that managing it yourself can work. And what you'll find as the strategies that you'll hear out there, one of them is when you buy your park, you interview all your tenants. And the one who's the most there'll be one or two tenants that you'll have in your park that will be appropriate management material to collect the rents and, send out invoices and send out notices and do that kind of general management, office management stuff. And then you'll probably find one or two tenants that are pretty handy and they'd be interested in helping you do repairs around the park. So that's not the fastest way to move the needle on a value add park. You can do it. It's kind of more, to me, that's kind of a Band-Aid or if you have a stabilized park, that probably works, right? But you're not getting professional, experienced management staff that way. You're teaching them and you're managing them yourself, right? Those are more like assistant managers and assistant maintenance guys. That's what that would be, right? So the way that we like to approach it is you hire experienced management staff and you import them. So they're not at the park. You import them and they move into the park. So sometimes, depends on the park, sometimes an office will also have, like a housing or apartment attached to it for the manager. Sometimes they'll just get the mobile home that's vacant that's right next to the office. Or sometimes the mobile home's big enough to where it can be the office and the mobile, and housing for them. So it depends on the park, right? But we like to find really good quality staff that we market for, advertise for, interview, and hire, and they become employees of the park. So we approach it a little bit differently. You'll find, depending on the area and depending on the size of the park and the amount of work that needs to be done there, you'd be surprised, but that's actually a career that people manage parks. That's what they do for a living.
Interesting.
So,
go ahead.
A lot of times what we'll find is that they come as a husband-wife team. So the husband is the one who manages the, repairs around the park and does whatever landscaping things are necessary and fixes broken water pipes and those kind of things. And the wife sits in the office and manages the office work.
Okay. Which software do you use for rent collection, knowing that those tenants usually like to pay cash, some of them? How do you educate them?
No, we don't allow our tenants to pay cash. So, and that's just it's a policy, right? So you can choose that policy and you just teach people how to do it differently, right? So that's one of the areas where you'll find that you expose yourself to untrackable income is when you accept cash, right? So you got to be careful with that. That it's hard to track that, right? So both from the tenant say I paid and then the manager says no you didn't, who's lying, right? And then the ability to skim. So particularly if you have any ancillary income at a park like overnight RV stays and those kind of possibilities, you're not there. You can't see if that's happening or not. So if you take that completely away and all of the income that comes in has to be done other than cash, you remove that whole variable there. So with respect to software, it really depends on what you're trying to accomplish and the type of park that you own. So probably the most popular software for this kind of investment real estate is Rent Manager. And you'll find that maybe 50% of the mobile home park guys will use Rent Manager. There's a handful of free ones out there that they work okay. They could be a little bit clunky because they're not built specifically for mobile home parks. And then particularly if you have, so in our portfolio, we have mobile home parks, we've owned RV parks that are straight, transient RV parks before. And then we also have hybrid parks that are more like resort RV parks that are filled up with park model RVs. So they behave very similar to a mobile home park in that somebody owns a unit that's permanently on that space and it never moves, right? But the difference is in the way that they operate, particularly even if you have a mobile home park that has 4 or 5 vacant spaces that you use for RVs. Now, all of a sudden, you have this daily, weekly, seasonal component that's transient, right? So your soft Rent Manager is really difficult time solving for those things. Doesn't mean you can't figure out a way to work it. But there's a couple other softwares out there that are specifically designed to solve for that. One of them is called Astra. One of them is called Manage America. And they're built, specifically to solve for mobile home and RV component. So it really depends on the park.
Okay. So, but the free ones could be okay with managing a mobile home park?
Oh, sure. Yeah, if you just have one. So like when you start to scale, here's where the right software solutions and the right, asset management, strategies and systems and processes, they start to matter when you start to scale.
Mm.
So if you have one park, I mean, you could get by with spreadsheets, Quicken and QuickBooks and Excel spreadsheets, right? But as soon as you start to scale, it becomes cumbersome. And you need to be able to have one central access to all of it, right? So that's when better software becomes necessary. So there's probably a half a dozen free ones that work when you have one park that you don't really need to spend the money. The better the software, the more expensive it is.
So, and how do you get the tenants? So if they don't pay cash, or do they use their cash to go to the machine, or how does that work with your rent collection?
No, I don't do the asset management side of our business. I have a business partner who's brilliant at it and he manages all that. So I know that there's digital solutions for that, where they can use their card or their debit card or whatever. I know that even works with Venmo or Cash App or a lot of these newer, phone app based payment systems. But some of them pay with like a money order or a cashier's check from the bank, right? So we just don't accept cash.
Okay. You talk about MSA. What's the minimum size of the MSA for you to invest?
So I don't know if it's a minimum size as much as it is what's happening in the MSA. So typically, I would probably say that if you were just going to kind of look at generically, MSAs of 10,000 people or more are probably appropriate to start looking at. But it has a lot to do with what's happening there. So, if I look at Arizona, we specialize in buying parks across the state of Arizona. That's we like to buy them in within a half day's drive of our home. So if there's some kind of acute challenge, we could drive there and solve it and drive home and sleep in our own bed that night, right? But there's 50 MSAs in Arizona, and we probably wouldn't buy parks in but 15 of them, right? So one of the simple things, and you may have already heard this before, is that if there's no Walmart there, you probably shouldn't be there. So Walmart does an amazing job of demographic research and understanding what's happening in this market. So during some kind of recessionary times, are the Walmart customers still going to have jobs and still going to be shopping at Walmart, right? Well, it turns out that mobile home park tenants are the same demographic. Those are Walmart customers. So, if Walmart's not there, that should be a red flag. That doesn't mean you shouldn't be there, because Walmart's not in Aspen, Colorado, but you would definitely want to own a mobile home park there, right? So there are exceptions to that rule. But typically where you'll find that Walmart won't go are markets where the population is not growing. There's no job growth, or the job growth is not aimed in the right direction. So the economic forecast is not positive, or the population growth is not positive. Those are the two things that would be a deal killer for me in a market.
I know you do syndication. You've mentioned the fund. So could we talk about the syndication first, and how you go about syndicating your deals? Sorry, let me rewind. How do you source your deals? Where do you find your deals? You say you specialize in Arizona. How do you go about finding your deals?
Yeah, so there's 2 or 3 different ways to approach that too, right? So the common way is, I'm going to get to know all the brokers that specialize in this space, get on their list and underwrite the deals that they send to you. So in a normal market, that's probably an okay strategy. In a market where there's a tremendous amount of demand for the type of asset that you're buying, you're probably going to be bidding for deals, right? So it doesn't mean you can't still buy deals. It just means that you better get ready to bid, and you have to be the winning bidder to get the deal, right? So if you want to kind of take that off the table and have an environment be where it's just you at the table, or maybe you and one other consideration, you have to be buying deals that are not on the market. So buying deals that are not on the market really only occur through two methods. One, you build relationships directly with the owner of the park. And two, you build relationships with brokers who, in a fashion where your relationship is deep enough to where they'll give you deals that are never going to get listed. So if you put yourself in the shoes of the owner of the real estate, there's one of three things that are going to happen. One, you don't like brokers at all. You can't stand them. And if you're going to sell the property, you just want to sell it to somebody that you like, right? Two, you're just fine with brokers, but you don't want to list it. So a broker will call you, and you know, once you own parks, I mean, I get calls from brokers all the time, right? Jack, come on, I can get you X amount of dollars for this park. So you may not want to list the property, but you'll say, well, if you can get me that kind of a number, bring me an offer. That's a pocket listing or an off-market deal that's not going to get listed. So I'm not going to give you a listing, but if you bring me an offer, I'll consider it, right? And then the third one is, I want you to put this on the market. I'm willing to pay your commission. And I want to get the highest dollar that the market can provide, right? So it depends on who the seller is, right? So every owner of real estate has a different perspective. Some of them want to sell it to the highest bidder, and they want to go through the whole process of marketing and brokerage and all that kind of stuff. Some of them want to do it off market, but they do want a broker to go do the work. And some of them would prefer to sell it directly to somebody that they have built a relationship with. So it really depends on who the owner is. And then of course, your strategy depends on how much time you want to spend. So let's say you have your eye on a particular park and you really like to buy that park. Well, building a relationship with that owner would probably be a smart thing to do. So particularly if it's not for sale, because it gives you time to build relationship, but that takes time. Do you want to spend the energy to do that? So, or do you want to spend all of your energy looking at a wider variety of deals in a wider variety of markets? Well, then you may as well get brokers to send you deals. So it really depends on where you want to put your energy, where you want to create value. And then of course, I believe that if you buy that park directly from that owner, you're probably going to pay a fair price for it. It's probably going to be a fair deal for both of you. If you're competing against institutional capital on an asset that you really want, you're probably going to have to overpay for it to get it. So price becomes part of that. Speed of transaction becomes part of that. Favoritism with brokers becomes part of that. I mean, there's a lot of pieces at play there.
And you also must have a track record of being a closer too with the brokers.
Sure, absolutely. Yeah. So if it's your first time and you haven't never bought a park, you know, you're probably not going to be the first one they call. Yeah, that's true. Yeah.
Thank you. Have you seen evolutions in the market? Where is the market now?
The market in general, or the market for parks, or what are you
specific? Yeah, for parks.
So it's interesting that if we back up about 5 years, if we were to back up about 5 years ago, you know, we were certainly out of the bottom of the market, and the market was stable in general, right? There used to be a 2 to 3 point spread in cap rates between multifamily properties and mobile home parks. It's where it used to be. That spread, not only has it shrunk to where it's the same spread, there's cases where it's flipped. So, you know, obviously I focus on the Arizona market, so I'm really, really in tune with what's happening here. But we've seen parks trade in the 3 and 4% cap range, even in markets, 3 and 4% cap range. Even in markets where apartments are selling for 4 and 5%. So depends on the park, depends on whether it's an institutional quality asset or not. Depends on the size of the park, how many acres it sits on, where it's located, because mobile home parks, they're cash flowing assets, and their recession resistant performance is important, but they're also covered land plays. So when you think about, a 50-year investment time horizon, for example, from a private equity REIT like Blackstone or Carlyle Group or one of those type of entities, if they're buying 100 acres, that's going to give them cash flow, but it's positioned in the path of growth, and they're going to own that park for 50 years. It's highly likely that the value of the land will be worth more than the value of the park at some point, right? So they're looking at it from both an income generating asset while they own it, but also as a covered land play. So there's that part. I was surprised to see those kind of transactions taking place, but they are taking place. So now that's only happening in the Phoenix metro area. So you wouldn't find that in a small town like, Flagstaff. Yeah, Bisbee for sure. It wouldn't happen down there. But even in a town like 50,000 people, like Sierra Vista, right? So there's 50,000 people there. You wouldn't see that kind of action happen there. But traditionally, Sierra Vista has been a 10 to 12 cap market for an asset like that. People are paying 6 to 7 caps for assets in a market like that. So we're getting to that spot in the marketplace where it's difficult for investment capital to find yield. When they become hungry for yield, they're just starving for yield. They're going to go buy assets where they can get the greatest yield. So mobile home parks tend to deliver that. So you'll see companies that traditionally were, commercial, retail, office, apartment acquisition strategies. They're also buying mobile home parks now because they're trying to, add yield to their portfolio. And they're also looking at, we're probably 2 to 3 years from the end of the cycle. So when a recession comes, we want to make sure that we are exposed to the mobile home park asset class because it's going to deliver recession resistant income. So COVID's kind of proven that already. So it's, our portfolio of parks, really didn't experience a hiccup at all during this whole COVID thing.
Same with me with my park. It's like nothing happened.
That's right. Yeah.
Can you talk a little bit about the syndication? So how do you go about doing syndication? What makes you a good syndicator?
That's a fire hose. That's a lot. So, we could spend a whole day talking about this topic right here and not touch it all. So I'll try to be general enough to where we don't drink from the whole fire hose, but enough to where you can get a taste of it. Syndication, just from a nuts and bolts perspective, for those of you or those of your viewers that aren't familiar with it, syndication is just kind of a fancy word for I'm going to pool some money together from people who are just passive investors. And I'm going to place that capital into this property that we're buying. I'm going to turn it around and we're going to share the benefits of owning that real estate together. That's in really simple terms what a syndication is. So a syndication, anytime that you're using passive real estate or investment capital, it requires that you do it correctly. So you have to get a securities attorney to draw up your syndication documents. And I'm not going to get into those documents, but there's a lot of variables that exist there with respect to what type of entity that we create, what kind of structure we create, what kind of preferred returns we're going to deliver, the time that we're going to own this together. I mean, there's so many factors to consider. Sometimes the sponsor's business plan or their strategy with respect to what they're doing in real estate will dictate what those look like. Sometimes the experience and the amount of times that you've done this kind of thing will dictate it. Sometimes it will be the actual asset, the type of asset that it is, that will dictate it. So there's so many factors, it's hard to broadly characterize that. But just in general, know that when you syndicate an asset, it's nothing like using your own money or partnering with your brother-in-law. It's not like that. So anytime that you're syndicating an asset, it becomes a security. So you have to follow the securities regulatory or the requirements in the securities regulatory space. What was the other question that you had asked?
What makes you a good syndicator?
Okay, there you go. So syndicator, and if you research this online, you'll hear a syndicator called a sponsor. You'll hear him called an operator. You'll hear him called the general partner. And there's a lot of different terms that they call them. But a syndicator is the person who finds the deal, he raises the capital, he puts the deal together. He's the one who hires the attorney. He's the one who turns the property around. He's the one responsible for reporting. He's the one responsible for doing the taxes, all the bookkeeping, distributions, all those kind of things, right? So what makes a good syndicator, and this is the kind of an interesting conversation, is that in the beginning, what makes a good syndicator is he good at real estate? So if you've never syndicated an asset before, and you're getting ready to syndicate, which means you're asking people that you know who already have a relationship with you, would you invest some money with me if I did this project? The first thing that they're going to ask you is, have you done a project like this before? So when you consider the perspective of the potential investor that you're about to work with, people would think that the first thing they're going to consider is, how much money can I make if I invest with you? That's going to be important, but that's not the first thing that they're considering. So the most important question that you need to ask yourself if you're syndicating an asset is, how can I demonstrate that they're going to get their money back? So the first question that an investor is going to ask you, let's say I'm an investor and you're showing me a deal. First thing I want to get comfortable with is, am I going to lose my money if I invested with this guy? So I'm more concerned about being comfortable that I'm going to get my money back, the original capital that I'm going to invest with you, than I am how much can I make. So the first answer to that is that question, what makes a good syndicator, is somebody who can demonstrate and allow investors to become comfortable that not only are they going to get their money back, like they've solved for every risk that exists with respect to the potential loss of capital, but they're also going to have a chance to make money too. The second thing that I think makes a good syndicator or sponsor is, do they have everything designed in their business to deliver a good experience after the investment has been made? So consider that, investors get excited about being part of a project and they'll invest $100,000, for example. But what they many times neglect to consider is, we're going to be invested for a while together. So in my case, it's 7 years. Like most of my investors that invest with me are looking at a 7-year time horizon. But regardless of the amount of time, it's not going to be just today. It's that you're investing for a long period of time. So what's my experience going to be during that 7 years that I'm invested with you? Am I going to have regular reporting that's structured and it's scheduled on a specific day and I can expect to get it? Am I always going to know what's going on with my investment? Is there any way that I can check to see how it's going in the middle of the night, for example, right? So some more advanced syndicators will have a dashboard and you can go log in 24 hours a day and look at your investment and how it's doing, right? Is there financials that are shared with me on a regular basis? Am I going to be able to see a balance sheet? Am I going to be able to see a P&L so I can see what's happening at the property? Are there distributions that are going to happen along the way? Can I count on those occurring at regular intervals, always on the day that you promised that you would give them? Am I going to get my tax documents in time so that I can file my taxes on time? So there's so many things that most syndicators or sponsors are focused on the real estate. Like they're 100% aimed at the real estate. They know how to find good deals. They know how to execute and close them. They know how to turn them around. They know how to collect the rent. They know how to do the real estate tasks. But there's another whole business in creating a best experience for your investor clients. So I'll share a story with you. It's a perfect example of this. So I have an investor friend of mine that I've known for 10 years, quite a while. He's got there's two separate experiences that he's had, and we'll call me sponsor A, and we'll call the other guy that I know who he is sponsor B. Sponsor B offered him a higher return, offered him 18%, for example, right? I only offered him 12 to 14%. His experience working with me is there was transparency and accuracy in everything that we did. He could set his clock by me. If I said I was going to report on the 20th of March, he could just set his watch, and when I report, it's the 20th of March. Like, it always happens exactly when we said it would, right? There was regular ongoing transparency with respect to the performance of the property. Distributions were paid out on time. Tax documents showed up on time. Everything went on time. And he got exactly what he was expecting to get. With the other guy, he got no reports. He never knew what was happening. Sometimes it was 6 to 9 months with no communication at all. He's calling them and leaving voicemails and sending emails, and he's not sleeping very good at night because he thinks the worst possible thing has happened here. This project has gone sour and I'm losing money. That's what he thinks. Fast forward and the project closes and he gets his money back and he gets his 18%. You'd think that he would want to do that investment again, but no, he doesn't invest with that guy anymore because the experience was a terrible one. Even though the yield was there and he made the kind of money that he had been promised, he just didn't like the experience. He couldn't file his taxes on time. He never clarity, never had transparency, right? So it's really interesting that when you discover that if you as a sponsor will deliver the things that matter along the way. So it's not just making sure that you're smart and intelligent about buying the right deal, structuring the right capital stack, getting the right flavor of investors to come join you as you buy an asset. It's equally important that you have systems and processes built beforehand, so that you know that you can execute on these things that matter to investors so they can have an incredible experience. I found out that really good, powerful communication on a regular basis, transparency, accuracy, all those kind of things, that's worth 2 to 3% of emotional yield. That's what allows people to sleep at night. So it doesn't really matter if you're projected to make high yields. If you can't sleep at night, it's not worth it. So, and then of course, track record and performance and all of those things, the third thing that investors are going to care about is how much money can I make? How long have you been doing this? And have you historically delivered those kind of yields? Is there more upside, or is there a real opportunity here for me to make more money than what you're projecting? So are you being conservative? Or are you overhyping this investment? Doesn't really do you any good for building track record if you promise people 18% and you only deliver 12. You may as well promise 12 and deliver 14 and knock it out of the park that way, right? So that's probably very broad, but from a syndicator perspective, if an investor is looking for a good syndicator, those things are going to be important. Now, here's what is going to be the most difficult thing for anybody who doesn't know the syndicator. I don't know this guy. How do I know I can trust him? So it really doesn't do you any good to invest with somebody if you can't trust them. So that's going to be probably the greatest hurdle for new investors, is to learn how to trust the sponsor or the syndicator. But there's a couple of ways that they can vet that out. So one of them, if the sponsor has undergone a deep level of verification by a company that does the verification, and there's companies that do that. Now, every sponsor won't want to go through that. We do, but that's just because we want to be world class, right? But that'll show like background checks, criminal background checks, fraud background checks, even credit history verification, all that kind of stuff that matters from the individuals who are the sponsor. And then they'll underwrite the company. They'll really do a deep degree of validation on the company. Are they running their company in the right way? Are they using the correct software? Are they doing their accounting on time? Are they filing their taxes on time? Do they deliver K-1s on time? Do they actually own the assets in the LLCs that they say they do? Is all of their banking separate per LLC? Like all these things that they dig in. And just like any institutional background check would be done if somebody was about to go invest in a company or in a business, right? So that's one way. The other way is every good syndicator will have investors that have known them and have already gained an experience with them over the course of time. So if I'm going to come invest with you and you say, oh yeah, I've been doing this for a while, can I visit with some of your existing investors who've known you for a long time without you being there? It's just me and them on the phone ourselves. If you tell me no, well, that means you're probably hiding something. So, it's a pretty easy litmus test to see if they won't let you talk to their existing investors, then they have something to hide. So that would be a red flag for me. But that's probably the easiest way for a new investor to gain comfort is, are there other smart people that have invested with these guys before and have had a good experience? If that's the case, I want to talk to them because I can build relationship with the sponsor that I don't know yet through these guys' long-standing relationship. So yeah, there's a way to overcome those things.
Yeah, trust is the key factor.
For
Building
sure.
trust and maintaining trust through transparency and consistency.
Yeah.
So I know you created a fund. So why a fund compared to syndication? Are there advantages to a fund?
So again, for those people that are watching this that are not familiar with the difference between a fund and a syndication. So fund is still a form of syndication, but most people will use syndication to speak about a single deal, right? So a direct investment into one property, right? A fund typically will consist of several properties. So like in our fund, instead of buying a single mobile home park, raising the capital for that one mobile home park, and our investors have an ownership interest in that one mobile home park. A fund is where we'll buy, 5 to 10 mobile home parks over the course of 2 or 3 years. And our investors will own an interest in all of the parks that are owned inside of that fund. So what's really neat about that, there's 2 or 3 things that are advantages both for the sponsor and for the investors. So from the investor's perspective, you gain diversification. So consider if you love the sponsor, they're great at what they do, they're honorable, they're transparent, they're doing all the things right. And let's say they buy 10 different assets and one of them gets wiped out by a fire, for example, right? Now you have insurance that will give you time to put it back together, but still impacted during the time where it's not operating, right? There's loss of income there that occurs, right? Just for example. If you were in a fund, that probably wouldn't have much impact on you at all as an investor. It would impact me as the sponsor if the fund is crafted correctly, because the excess income comes to me, and that would be the excess income, right? So the diversification across many assets allows you to, so that's a drastic example, is the park got completely wiped out. But there's also the example of you buy a park and it takes longer to turn it around than what you had originally projected that it would take. So it's slower to get to where the yields are meeting the projections, right? On the other end of the spectrum, you'll buy a park where you get there faster, or there's more upside than what you initially thought, right? So if you have to select and choose, like even me as the sponsor, I do incredible due diligence before we buy a park. I pretty much know how it's going to run. But once you own them and you start, it's like babysitting a child. They look great. but then you bring them over and you start to babysit them and they behave differently than you expected, right? So it's the same thing that happens with parks. Some parks, you'll be able to move them down the path quicker. Some come down the path a little slower than you expected, right? So in a fund, you don't have to worry about those kind of things. That all of that kind of blends, you know, the overperformer overcomes the underperformer. You always get to have a piece of the home run. It's just it's a tremendous benefit to investors to be in a fund if the asset class suits what they're trying to accomplish, right? From a reporting perspective or from a documentation perspective, the same thing exists. So some of our investors would build their own fund if we were syndicating every single asset forever by just buying, you know, $100,000 in every single park that we do, for example, right? So they're basically making their own fund. But think about it, they're going to get, they invest in 10 different syndications with us. They get 10 separate K1 documents at tax season, 10 separate quarterly reporting documents for all of these assets every quarter, 10 separate distributions that are all going to be different based on the individual assets, you know, performance. It becomes really cumbersome. It's a pain in the butt for everybody. So you look on my side of the table as a sponsor, it's the same thing, right? So instead of giving, you know, you one document, one K1 at tax time, one distribution from the performance of the collective performance of the entire fund, I'm doing that 10 times for every investor that I have. So, you know, it can easily or quickly become administrative snowball if you when you start to build a portfolio of assets and you syndicate them individually. Now, companies that flip assets and their ownership time period is short. Apartment guys will do this a lot. So they'll buy an asset, they'll improve it in 12 to 18 months. They'll push the rents and build their T12 performance. They'll put it on the market, and in 36 months, it's gone, right? And they may only own 4 or 5 assets at a time, and they're just continuing to roll those, right? So a fund doesn't necessarily cause that administrative snowball if you're selling your assets in a quick period of time. But if you're building a portfolio that you intend to keep for a longer period of time, that's when it starts to become, that administrative snowball gets to be a little bit overbearing. So that's where a fund really makes a lot of sense. So it's simple. Like the other things that are kind of neat about it is that you can raise money in advance of the need. So from the sponsor's perspective and from an investor's perspective, you know, if I'm going to buy a single asset, we don't really know how it's going to perform, but based on our experience, we can make a good projection where we think that will land. We don't really know until after we close on it, we own it, and we've started to operate it for a while, whether it's going to be a slower one to move down the path or a faster one to move down the path, right? So you can't sit here as an investor and just wait until you get the perfect one, because nobody really knows, right? You're basically investing in the sponsor and their track record, right? So in a fund, you can look at the performance of the fund already. How is the fund performing? They already have 4 or 5 assets in the fund, and they're going to buy 4 or 5 more, for example. Well, if the fund is already performing at a certain rate, you're investing in something that's not speculative. It's already performing, right? So it makes it much easier for an investor to say, I want to commit some capital to this, even though I know you're not going to ask me to invest until you find your next deal. I just want to be inside of a fund that's already performing. So it's a simpler, it becomes simpler for an investor to get over the hurdle of the speculation versus existing performance. But it's also easier for me as the sponsor when I've gotten, you know, commitments from enough capital partners so that I know when I put the next deal in contract that I already have the capital ready to close it. So I can probably get a little bit more aggressive, which allows everybody to win. So imagine if you and I are negotiating, you're the seller, I'm the buyer, right? You want $2 million for your property. And I tell you, hey, I'll tell you what, I'll pay $1.8 million and I'll close in 3 weeks. You say, oh, if you'll do that, I'll do it, right? Okay, well, if I know I have $1.8 million ready to go, then I can save $200,000, which benefits me and all of the investors. Everybody wins from that, right? So if you don't have that capital raised, you don't have those commitments, can't do that. So you're just going to take the slower path to closing and pay more money for it, right? So it's it doesn't. I'm not saying that that happens every single time, but there are advantages to both parties inside of a fund, you know, through that lens.
Mm. And can you walk us through the process of setting up a fund?
Fund is going to be a little bit more complicated than a syndication. So, because there's quite a bit more things to be thinking about. So a syndication only looks at, we're buying this asset, we're going to raise capital until we buy it or until we close the deal, right? Then we're never going to raise capital again, in theory, right? Now there could be a disaster that happens and you'll need another infusion of capital. But if everything goes the way that it's planned and you don't have any major surprises or challenges that exist there, you're never going to raise capital again. When you sell the asset, you're going to give the capital back to the investors who, you know, where the pockets where it came from, and then you're going to distribute the profits in the manner that you've agreed to, right? Syndications can be fairly simple that way. Now there's still distribution of cash flow along the way and those kind of things that need to be solved for, but they're pretty simple. So in a fund, there's quite a bit more that occurs here, because you're not going to buy all of the assets in the fund on day one, obviously, right? So there needs to be anti-dilutive processes designed so that the first person that invests gains from investing, being invested longer than the last guy who invests, right? So the last guy that comes and invested in the fund 3 years later than the first guy, he doesn't get the benefit that occurred before he got there, right? So there needs to be an anti-dilutive effect, very similar to if you went and bought Tesla stock today, you can't buy it for the same price that the guy bought it for 6 months ago, right? So when appreciation has taken place, you need to buy it at the new price. So there's anti-dilutive measures that need to occur there. There's also different ways that the capital is paid back. So especially in a fund where the investors, all the investors in the fund have an equal interest in all of the assets in the fund, irrespective of when those assets were purchased. How do they get their capital back? So the way that funds work, which is quite a bit differently than the way that a syndication works, is each time that you sell an asset, you get a portion of your capital back. So if you invested $100,000, you might only get $10,000 back. Each time an asset is sold, you get $10,000 more back. When the last asset sold, you get your last $10,000 back, right? So, and then of course there's preferred returns that get paid on the amount that you still have invested. So there's quite a bit more things to be considering with a fund. How long can you raise capital and deploy it into assets? So, you know, our fund is a 7-year fund, but we can't buy assets for 7 years. You wouldn't have enough time to fix them up, reposition them, and sell them, right? So there's only a short window in the front that you are allowed to buy assets. Then there's a period that you stabilize the assets and then you sell them, right? So at some point, whether you've raised all the capital and deployed it or not, you have to close the fund. No more capital is raised. Otherwise, you can't meet those time frame projections. Then there's going to be considerations for, you know, because anybody who's investing in the fund, you know, even including the sponsor, is not going to know what are the assets that we're going to acquire over the next 2 or 3 years, right? How much debt are we allowed to deploy? Is there a ceiling or is there a threshold on the amount of leverage that we can place across the fund? Like there's so many different things that you're going to have to solve for in a fund. And if you don't have all those things written down in your documents, then you know, your investors are going to have questions that you can't answer, right? So a really good fund level attorney is going to be a higher degree, or it's going to have a higher degree of experience than a syndicate, you know, of your standard syndicated attorney. So like when we were doing syndications initially, we had a local attorney that understood, you know, he did securities work, but he was honest with us and said, hey guys, I'm not the best guy for a fund. I just don't understand them. So, we had to upgrade attorneys when it came time to do a fund. And then a fund also allows you to do what's called third-party administration, which is really neat. So a third-party administration allows a professional company that specializes in administrating real estate funds to do all of your bookkeeping, all of your oversight of banking, so that you get everything, all the expenses and income are tracked exactly. They can do your accounting for you. They'll do your distributions for you. They'll do all the allocation of waterfall distributions for you. They do all the quarterly reporting or quarterly statements for each investor. I mean, it really allows you to stay focused on the real estate. That's a difficult thing to add on a single syndication. It ends up being too expensive. But in a fund, it makes total sense.
How big is your fund?
Our fund is a $10 million fund.
So does that mean that's the value of the park owned, including the debt, or is that the down payment?
That's the amount of capital that we'll raise and deploy into parks. So another thing that you'll find in funds is that some funds are very generic and allow you to, we buy real estate. We're a fund that buys real estate. Well, that's pretty wide. I mean, that gives you a lot of levity, right? So our funds focus specifically on mobile home and RV parks with recession-resistant cash flow. That's the focus, right? So the more specialized and the more focused that you can be, the more simple it is for an investor to say, okay, well, these guys, I want to invest my money, and that's all they're going to do is that, right? I don't want to be invested in hotels right now. I don't want these guys to go out there and think they got a great deal on a retail building that you can't even fill up because everyone's going out of business, right? For example. So, funds require that specialized focus, or it's just unless you're Blackstone, that's different, right?
Okay. Yeah, that's very interesting and very inspiring. So to you now, what are some of the daily routines you have because it seems that you have quite a full life. I believe you have quite a few children. How do you manage to handle all of this?
Well, first of all, I have to say that there are two people in my life that support me the most are my wife, because we do have 7 children. And, I'm still the father and I'm still the husband of that family. But, in the working hours of the day, she runs that home like a business. So it's very well run, and I'm really lucky. And then my business partner, who manages all of our parks. So my daily routines are around building relationships with owners or brokers of parks that I want to buy, because we only need to buy a few parks a year. We're not the type of company that tries to buy a deal every 3 weeks. So we're very patient. We only buy deals that make great sense, right? And then the other half of my business is building and nurturing relationships with my capital partners. So there's people that I've known for a year before they finally are ready. So they're waiting for something to occur in their life or whatever. And then there's also, the core group of investors that invest with me right now. I need to spend the requisite time to make sure that their experience is amazing. So I do, there's a lot. So my daily routines are around those two things, building relationships with owners and building relationships with capital partners. And then I also support my business partner, Nate, in areas where he needs support. It's nice to have a business partner because he just went on a family vacation and I handled his workload while he was gone. And I appreciate him more when he comes back than I ever do, because he's really good at that job. So
Okay.
does that answer your question, or are you looking for more specific stuff?
Yeah. Do you still have your morning routine of the 1 hour?
Yeah.
You do your meditation. So what do you do in your morning routines?
So my morning routine advances all the time. So you and I probably spoke sometime in the last 6 to 12 months. But I spend time in the morning first alone with just with me, I'm a man of God, so I spend time being grateful. I spend time in prayer. I think that one of the greatest gifts that we've been given is from a spiritual perspective, is this belief that I don't have to know how things are going to happen. I just have to believe that they will. So I really spend time before I even begin my day, trusting that everything that I need is going to show up, everything that I need to, even the difficulty that I need to experience so that I can grow, the challenges that we need so that we can become the people that we're supposed to be, those will show up. But also the relationships that I need are going to show up. The opportunities that I need are going to show up. So I spend a lot of time, making sure that I'm set in that time or in that mindset before I go into my day. Allows me to stop or to not worry when things don't go the way I expected them to go. I like to exercise. So, I'm getting to where I'm middle-aged now. So if you don't exercise, it doesn't take long and the results of that show up. And then I like to spend, before I take off my day, I like to spend time at least recognizing that, I've got a great family and I got a beautiful wife, and before I go off into my day. So when I get to work, every day is a little bit different for me. There's certain days that I allocate or dedicate to, number of phone calls or number of touches that I make with people or certain KPIs that I have to meet. My business partner and I are pretty organized with respect to, everybody's got to have a number and everybody's got to meet or exceed their number every week. That's how we move the needle. So, and there's a lot of things that I do with respect to that. Just about everything that I do at work has some kind of scorecard or some kind of number related to it. And if I'm not doing my job, then you can see that we're not moving the needle. So, and he does the same thing. He has numbers with respect to the performance at the parks. And it's not just generic with, like you would think, like it's top line revenue. Like that's the result that occurs from doing the little things on a regular basis. So, how many advertisements are we posting for homes that are for sale? Will reflect how many homes or how many buyers show up, which will reflect how many offers we get, which will reflect how many homes that we sell. And those homes that sell end up, impacting the top line revenue. But if the numbers aren't focused on the top line revenue, they're focused on the number of ads that we're running, for example, right? So it's, every part of our business is designed in that fashion. Like, what are the things that we need to be doing on a daily basis or a weekly basis that will allow us to achieve the goals for this park? And we do that for the business. We do that for every park. We even do that with each one of our employees. I mean, everything that we do is designed in that fashion.
Very impressive. Okay, Jack, thank you for having us and taking us through your investment journey as a mobile home park expert. Thank you for your insights. I really much appreciate it.
Well, you're welcome. And thanks for inviting me. It's nice to share.
Yeah, thank you. Yeah, you like to share. Are you still big on Bigger Pockets and sharing your insights there?
Yeah, so I started contributing on Bigger Pockets because there was a gentleman that told me, he's like, Jack, you know so much, you can't possibly tell everybody. Why don't you go on there and just on a public forum start to help people solve their problems? I think that's where you and I originally met, yes?
Yes,
Yeah.
I enjoyed your answers.
Yeah, so I still do that to this day. It's really interesting that when I got started, there was many mentors along the way that helped me. And it feels good and it feels right that I should be doing that. But it also has introduced me to some neat relationships. So, I've run into, just like you and I've run into all kinds of people that connected me through Bigger Pockets because of the time that I spend sharing perspective there.
Thank you.
Yeah.
Yeah, well, yeah, we'll stop here. Thank you so much, Jack. And so I'm very impressed by your fund. I'm thinking of setting up one here in Canada as well.
Okay.
I'm looking at buying some micro units. It's like lodging houses.
Okay.
and setting up a fund dedicated to affordable housing,
Okay.
and put different types of housing that's affordable. So micro units is really low end, and then look at different types of housing I could put in there. And I was thinking that maybe some mobile home parks could fit the bill.
Well, I think we'll both agree that affordable housing is in great demand and it's not being recreated. So
No.
yeah, it's a really neat business to be involved in when the thing that's in the greatest demand is what you have.
Yeah.
Yeah.
And I really and like you said earlier in the interview, I see it with my park. It's like nothing happened. Like it's like the
Yeah.
property manager didn't even mention COVID. She
Yeah.
she
Yeah.
didn't care.
Yeah. When if it gets worse, it'll even get better. I mean, I know that we got one of my business partners on the board of the MHCA. That's the Manufactured Housing Community Association here in Arizona. And on the board with him are a bunch of older park owners that have been in the park business for, some of them 2 or 3 generations, right? Their grandfather built the park or their father built the park and now they're running it, right? And they kind of smile at us when you say, hey, I know you've been doing this for forever, your whole life. How is it when we go through a really difficult recession? And they smile and they say, you guys have no idea, it actually gets better. So in most cases, not only you have good demand in this market, as you've seen. We sold all of our available houses at every single one of our parks in the first 3 or 4 weeks of COVID. And most of them sold for cash. So the demand goes through the roof when people are seeking affordable housing. But what's really interesting that occurs is that, when you think about a deep recession like we had in 2008, 9, and 10, anybody that's seeking to tighten up the belt and shave down their monthly expenses, let's say they're in an apartment and they're spending $1,200 a month on rent, and they look over there and they could be in this mobile home park for $400 a month. They're like, that's a no-brainer, right? So now you end up getting more qualified residents than you normally do that have higher incomes that probably can pay cash. So it's in addition to the normal demand that you have this additional demand that's coming from a higher asset class, right?
Yeah.
So it's a really neat place to be. You sell your homes like hotcakes. You run out of homes, and you wish you had more spaces. So there's no question that if you're investing for, for more of a defensive strategy, knowing that there's some kind of market event that's coming, mobile home parks they're really difficult to beat. Yeah, that's why we do it.
Yeah. I remember in the interview we did last time for my blog, you were mentioning 2 other asset classes that are also resilient, but you were saying about medical buildings and self-storage, but
Yeah.
yeah, mobile home parks are.
Yeah. So one of the things that's neat about mobile home parks is they're not building new ones. So
Yeah.
it's an asset class that's actually shrinking. So they're knocking over old parks and building apartments on them or condos or some other development. And I really do think that self-storage is great, but they're building so much of it that there's become an oversupply.
Mhm.
So that becomes a challenge if you're buying older, value add self-storage facilities to reposition. You can't solve for the brand new one that goes up across the street, and now you have competition that wasn't there, and now your whole strategy has to shift, or maybe you can't even execute. So yeah, that's one of the things I really like about mobile home parks is that there's a low supply and there's a high demand, and that's probably not going to change.
Mhm.
Yeah.
So two last things for you. One is so I'm starting this fund. If I get into a difficult position or I have a question, is it okay if I shoot you an email to see?
Sure. Yeah, there's a consulting firm that we used when we built a fund. There's so much to learn, and you could
Yeah.
just ping me and I'll introduce you to those guys. I mean, I know the owner over there personally.
Okay.
But there's some really good guidance in that space. I think that when you're going to build a fund, there's three key people that you need to work with. One is a consulting individual or a firm that specializes. They've seen a million different funds created and they know how to architect them. Another one is the attorney. Attorney needs to be appropriate. And the other one is a tax accountant. So the taxes on a fund are going to be approached quite a bit differently than they will in a syndication. You need somebody that has that kind of experience, particularly the way that depreciation is allocated. So, there's all these things, all these tax benefits in real estate that need to be considered, because you have investors that are coming in at different times, and you have assets that are coming in at different times. And how are you going to choose whether you select bonus depreciation or not? And there's all these questions, and you need to have a good tax accountant there. And usually one of those guys knows the other two. So you don't necessarily need to know them all. You just need to get started. And I typically would suggest that you start with a consultant that understands and helps people architect and build funds. And there's more than one of those guys out there, but you ping me offline when you get ready to start, and I'll share that with you.
Okay. I have this idea, and it's possibly an illusion, of creating an entity that buys real estate and have a fund, and the fund raises capital for the down payment on the properties. And then I own, or my company owns the real estate, but no, the real estate is owned by the fund.
There are so many different ways that you can structure them. I don't think there's an answer to whether you can or can't do anything.
Okay.
So, I mean, there's funds out there, for example, that raise capital and they don't ever buy any real estate. What they do is they raise capital and they go try to find sponsors that are good at the real estate, and they just invest in the sponsors' deals. So, like, for example, let's say I was a syndicator and you like the kind of work that I do, and you'd raise capital and you'd find sponsors like me, and you'd invest your money or your capital that you raise into deals that I do, right? So they don't do any real estate. They aggregate good sponsors, right? Now, the problem with that is you're not investing directly with the sponsor as a investor, so that you're probably taking a greater risk because there's a middleman. So it'd be similar to, you're going to invest with a stockbroker who's going to place your money on your behalf. You're not actually selecting the stocks or the investments yourself. You're doing it through somebody else, right? And then he's going to get a piece of that. Well, but there's so many different things that are going on out there. There's guys out there that are raising capital just as debt. So their company essentially is a private mortgage company, and they go place debt on assets with sponsors. So if you wanted to buy a mobile home park and you wanted to use, 70% debt, they would place debt there, right? And then you would only have to bring the equity. So there's so many different things that people do. I don't think the answer is no, you can't do it, because it's being done. But it still needs to be done correctly. I think the important thing to consider is, if you don't do it right, not only could it be a mess, or could it be difficult to raise the capital, but there also could be, legal exposure that you have if you're not doing it right. Even if you don't know, you're still responsible to know.
Yeah.
Interesting.
And the other question I have is, I'm planning an event, a real estate investor event, an online event in a year or two. Would you be interested in speaking?
Potentially, yeah. If the timing lines up, yeah, potentially I would.
Okay, cool.
Are you talking about in person, or are you talking about
Zoom?
Zoom. Yeah. I don't have a problem with that.
Okay, cool.
It's fun. Yeah.
Yes. Yeah. Okay, Jag. Well, thank you so much for your time, and thanks for being on the show with me today.
Absolutely. Thanks for inviting me again.
Really appreciate it. What's next for you?
Well, we're going to go buy a couple more parks this year.
Okay.
So one we already have in contract, and another one I'm negotiating on right now. So we'll probably buy 150, 200 pads this year, and
Okay.
probably raise $3.5 million. So then we'll probably only have one more asset left to acquire with that fund, and then that fund will be closed. So
Ah, okay. So you create several funds.
yeah, so once we fill up a fund, then you begin the stabilization period with all those parks. But when we find another park, we start another fund. So we'll end up owning probably 5 to 7 assets in the funds that we create, and they'll all be, I don't know how many funds we'll have, because at some point I'll get tired of doing this, right? But for now, I love it. I absolutely love it, and our intention is to do this for about a decade.
Okay. Cool.
Yeah.
Until the next project, because you got tired of houses, then you did mobile home park, now you're doing funds. Okay, that's pretty cool.
Yeah. Well, you know what? Now I'm aimed at this thing called retirement. So in 10 years I'll be almost 60, and my children will be mostly grown up, and it'll be time to start thinking about retirement.
Okay.
Yeah.
Cool.
Okay. Well,
Okay,
thank you,
Jack.
and great Arizona.
Yeah, good to see you.
Yeah. Yeah. Okay. All right. Bye bye.
Okay. Bye bye, Jack.